Today, we are focused on producer authority and agency law for the property and casualty exam. First, let's define the key players. The insurer is the insurance company. The producer, also known as the agent, is a person authorized to act on the insurer's behalf. The applicant is the person or entity applying for insurance coverage. Once the policy is issued, the applicant becomes the insured. The relationship between the producer and the insurer is governed by the law of agency, where the insurer is the principal and the producer is the agent. This relationship grants the producer the authority to act for the insurer. There are 3 types of producer authority you must know for the exam: express, implied, and apparent. Express authority is the authority explicitly granted to the agent in their written contract with the insurer. For example, the contract might state the producer can solicit applications and bind coverage up to a certain limit. Implied authority is not written in the contract, but is necessary to carry out the express authority. If you have express authority to sell insurance, you have the implied authority to call clients and print business cards. The exam loves to test the difference between implied and apparent authority. Apparent authority is what a reasonable person would believe the agent has based on the insurer's actions or representations. For instance, if an insurer provides an agent with a company logo, marketing materials, and a rate book, it creates the public appearance that the agent has the authority to act on the insurer's behalf, even if they don't have explicit permission for a specific act. This is a common exam trap. An insurer can be legally bound by the actions of a producer acting under apparent authority, even if those actions exceed their express authority. This is because the purpose of the apparent authority doctrine is to protect innocent third parties who rely on the reasonable appearance of authority created by the principal. For example, if a producer with apparent authority tells a client a specific loss is covered, the insurer may be stopped or prevented from denying the claim. Another critical concept is the producer's fiduciary duty. A fiduciary is someone in a position of trust. Producers have a fiduciary responsibility to both the insurer and the client. This means they must act in good faith, with loyalty, and handle funds with extreme care. A major part of this duty is properly handling premiums. Premiums belong to the insurer, not the producer. Commingling, or mixing these premium funds with personal or business accounts, is a serious violation of fiduciary duty and a frequent topic on the exam. To remember the types of authority, use the mnemonic IEA: implied, express, apparent. Implied is what's necessary, express is what's written, and apparent is what the public perceives. On the exam, you will see scenario-based questions asking you to identify the type of authority or determine if an insurer is bound by the producer's actions. Watch for wording that describes what the public sees or believes. That's your clue for apparent authority. For free practice questions, AI-powered explanations, and more exam prep tools, visit openexamprep.com. That's openexamprep, all one word, .com.